The fact that silver has come up, whereas gold has not. I'm going to look to accumulate silver rather than gold, or if I'm doing both, more silver than gold in terms of dollar investments. I saw gold going down and military action going on in Iran. I said, is this truly a paradigm shift? We now have a really hard ceiling. Above 5,500, that's where the record high is. You can buy it right now for 4,350. I'm looking at major support right above 4,000, so I feel safe in buying it. I see silver moving to a different tune, a different drummer, any way you want to say it. There's been a tremendous disconnect to a degree. You will see gold and silver move in terms of the direction in the same direction. Gold and silver tend to move up when there's bullish market sentiment for the precious metals and down when there's bearish market sentiment. The key is when you look at the Fed's dual mandate, maximum employment and inflation around 2%. If employment stays strong, but inflation continues to grow, the only tool is to work with interest rates.
At $4,300 gold, with everything you just said, the macro backdrop that you just excellently provided, Gary, what is gold to you right now at this current price level? Is it an investment? Is it a speculative trade because you believe there's more short-term upside? Is it a sell opportunity? Or is it just something to stay away from?
It depends on your goals. Now, I can tell you for me, I have been very slowly accumulating physical gold, holding it in a safety deposit box. As it got really over about 3,500, I slowed down to whereas I put that on pause because I didn't know how high it would go. And, you know, it was at 3,500. And when that was an all-time record high, you're not certain it's going to go to 5,500. If I would have known then what I know now, I would have continued to buy. Now, I believe that people that have taken the advice of many advisors, including myself, which is that all portfolios should have 10 to 15% of their assets in something like gold or silver, physical gold or silver. If you've been following that rule, you've already got some kind of a stockpile. So at this level, you want to add much slower than you would typically accumulate, but you still want to accumulate because we know we now have a really hard ceiling above 5,500. That's where the record high is. You can buy it right now for under 4,100. I'm sorry, 4,350. That's how fast it's moved off of this. So my recommendation for those that have been actively accumulating, you want to continue to do it at a slower pace.
Markets celebrate new highs, but wealth is usually protected by what investors refuse to chase. As Gary Wagner points out here, the shift isn't abandoning gold. It's changing the pace of accumulation. The overlooked signal is the conviction stayed intact even after prices accelerated, which is the opposite of speculative behavior. Institutions scale entries while retail waits for certainty that never arrives. For long-term holders, position discipline matters more than price perfection. Next, Gary Wagner exposes why the level everyone calls expensive may actually be where institutional accumulation quietly begins.
For those that are just considering that, let's say you've gotten out of college, you've worked for a couple of years, and now you're trying to decide how you allocate into stocks, bonds, and things like gold or silver. You still want to look at 10 to 15% as a max, but at this level, you might only want to put 7 or 8% right now until you see it back up on a strong upswing. You certainly don't want to liquidate, at least in my opinion, because when you're buying physical, it's a it's a decade kind of investment. When I buy something like that, it's probably going to go to my kids. I'm not looking to do anything with it. Luckily, I've never had to liquidate it. So I will continue to accumulate, but at a much slower pace. For those that are just getting started, rather than looking to allocate 10 or 15%, initially try to allocate 5%. And if it does move down to different levels, so let's say, for example, it did break below 4,065, my next major level of technical support is about 3,900. You'd want to allocate more there, dollar cost average on the way down. If it breaks below there, On a technical basis, the next level doesn't come until about 3,400. But I say that with one huge caveat, and that is fundamental events rule. That's what moves the price of gold, not the number on a chart. The technician is able to look at valid points of potential levels, and we always have to say it that way, potential levels of support and resistance. Right now, I'm looking at major support right above 4,000, so I feel safe in buying it, but accumulating it in small amounts rather than medium or large amounts.
Wall Street trains investors to think allocation is about maximizing returns, when real allocation is about surviving cycles. According to Gary Wagner, support levels matter less than the event that breaks them. That distinction matters because charts don't create price. Policy shocks, liquidity shifts, and institutional repositioning do. The quiet message here is that preserving optionality beats deploying capital all at once. Small entries protect savers when narratives fail. Next, Gary Wagner reveals why the market's obsession with technical levels ignores the one force that actually reprices gold overnight.
With the goal of maintaining 10 to 15% of my portfolio in physical gold or silver. And I think that that's a good rule of thumb. Even if you're just starting out, you might want to start out rather than allocating 10 or 15%, allocating 5%. If it does move lower, use that as an opportunity. I don't see a free fall here. And the reason I don't see that is if central banks are going to be actively accumulating, that should hold a floor on gold. That should create the bullish momentum that faded. That could drive that back into existence.
Well, what about silver? Is silver the same narrative as gold right now? And we'll finish off here.
Okay.
Take a look at chart of silver.
Sure. The last thing I would say is silver is a safe alternative.
Silver has also fallen from its highs now. You'll recall that silver has reached unprecedented triple-digit levels. It's still high by historic standards at well over $69, $70 as we speak right now. Well off its highs of 120 though, just a couple of months ago. And so the question is silver now dependent on the price of gold, or do you think silver's charts look like it's moving independently? What do you see?
First, I see silver moving to a different tune, a different drummer, any way you want to say it. There's been a tremendous disconnect to a degree. And the degree I mean is typically you will see gold and silver move in terms of the direction in the same direction. Gold and silver tend to move up when there's bullish market sentiment for the precious metals and down when there's bearish market sentiment.
Markets can fall hard, but they rarely collapse while the biggest buyers are still accumulating. What Gary Wagner is highlighting is not price optimism. It's the possibility that central bank demand has become the hidden floor beneath this market. Silver separating from gold is the more interesting signal, because divergences often appear before narratives catch up. For wealth preservation investors, watching who accumulates matters more than listening to headlines. Next, Gary Wagner exposes why silver's behavior may be revealing institutional expectations long before gold confirms them.
The one thing that to me stands out, this red line that we're looking at is the 200-day moving average. And you can see that on last Thursday, the 11th day of June, it actually moved into it. And then on Friday, yesterday, and today, its price point has remained above the 200-day. We've seen the narrowing between the 50 and 100, but the key is, if you recall from the gold chart showed that gold was well below the 200-day moving average. Silver is not. So in that way, it's been more sensitive, but yet it has shown a more bullish inclination because, again, as a market technician, if silver's above its 200-day moving average on a long-term basis, it's bullish. If it's below, it's bearish. So if we use that as kind of a benchmark, and the 50-day is a short term, of course, then silver is back in a long-term bullish scenario. And when we look at it, and I can compress this to a degree where you'll see here's the last time silver dipped under this was in April of 2025. Look at how these two lines widen. Look at the width that came between in the middle of March this year, and realize that during that time you had this tremendous sell-off. You then had a lower high, lower high, lower high, low, lower low, lower low. Whenever you've got a series of lower highs and lower lows, by definition, that there's selling pressure because you're going to get higher highs and higher lows in the market moving higher. So we're not out of the woods yet, but there's a ray of hope.
The market doesn't ring a bell when momentum changes. It quietly shifts while attention stays elsewhere. Gary Wagner's argument suggests silver holding above its 200-day average is less about technical optimism and more about a change in participation underneath the surface. Historically, sustained recoveries begin with narrowing weakness before broad confirmation appears. Investors focused only on price often miss that trend structure, changes first and headlines follow months later. Next, Gary Wagner unravels why silver's recovery signal may contradict the bearish narrative dominating financial media.
The fact that silver has come up, whereas gold has not. And so, to me, when I see something like this, as I continue to accumulate, I'm going to look to accumulate silver rather than gold, or if I'm doing both, more silver than gold in terms of dollar investments. And that's what I've been doing. Since recently, I've been purchasing small amounts of silver, and I've kind of held off on purchasing gold.
Finally, Gary, what would change the Fed's opinion on rates this year? Either what would motivate them to continue hiking, which is what the markets are predicting they would do by the end of the year, or start cutting rates?
Only one word: inflation. If inflation, which is at 4.2%, moves down to 2.5%, it's close to their 2% target. At 2%, they probably would consider cutting rates. But as long as you have inflation elevated, and when I say elevated, it's relative. I've lived through Clinton era periods where we had 15% inflation. I mean, I've seen inflation. Anyone that's 50 or older has seen real inflation. Not to make this a non-starter or an unimportant point that it's at 4%, but relative to where we have been and where we are, inflation has become extremely elevated. The key is when you look at the Fed's dual mandate, maximum employment and inflation around 2%. If employment stays strong, but inflation continues to grow, they work their one tool. Their only tool is to work with interest rates. It's the only real tool they have. They can raise them, keep them the same, or lower them.
The biggest portfolio damage rarely comes from volatility. It comes from believing policymakers are fully in control. This is where Gary Wagner's thesis shifts from metals into monetary reality. Inflation near target doesn't automatically produce cuts if inflation expectations remain elevated and credibility is at risk. That matters because rate policy changes asset pricing faster than economic headlines. Savers who ignore policy positioning often discover risk after it reprices. Next, Gary Wagner reveals what inflation persistence means for metals and why official targets may matter less than public confidence.
And so they're going to act appropriately based upon what the most recent numbers of inflation are and the predictions of where it may go. So even though it's relatively high now compared to what it was a year ago, it's based dominantly on high energy costs, crude oil, and that can be explained by the conflict in Iran because they shut down the straits, and that's where a good portion of oil comes out of. If, in fact, they resolve the problem and maintain that truce and come to a lasting peace agreement, we will see crude oil back down on a long-term basis. We saw it tank over the last couple of days, but it could easily go up if the truce is broken. So what the Fed is looking at more than anything else is inflation as well as maximum employment. Employment hasn't been a big issue, but inflation has been the primary driver of what's on the minds of the Federal Reserve members. The second thing is we're so used to Powell being the chair at the head of the Federal Reserve Bank that we want to really see, and we won't see it except maybe through statements in the minutes. And that doesn't come out tomorrow. We'll just get a press, I believe, because Powell had a press conference at 9:30. That's my time. 9:30 in Hawaii, but I believe that's 3:30 in on the East Coast. He would hold a press conference on Wednesday following the FOMC meeting. So that will conclude on Wednesday. I would imagine that Walsh could easily follow that protocol. I think it's a good protocol that he speaks to the American people, especially since he's a new chairman.
Energy shocks disappear from headlines faster than they disappear from prices. As Gary Wagner points out here, the market keeps treating inflation as a solved problem, while policymakers continue reacting to future expectations, not current comfort. Oil volatility creates second-order effects that alter rate decisions long after media attention fades. For long-term investors, inflation narratives matter less than the institutional response that follows them. Next, Gary Wagner exposes the contradiction between public confidence and what central bankers may actually be preparing for.
Now, Powell's still going to be there. I believe he's got a good couple of months, up to about 6 months, in which he's still going to be a governor, no longer the chairman. So you've got Powell there, but I'll be interested to see what Walsh says, and most importantly, with the Fed, I call it Fed speak. What they say, you have to read in between the lines. And then most importantly, the statements are the same statements from the prior FOMC where they change the language of a couple of sentences maybe and see what changes are in there to get an idea of the forward path and thinking of the Fed. And that's really going to be, I think, the most important economic news that comes out this week.
Tell us about why gold didn't behave as some traditionalists would expect it to this year. I'm talking about gold's reaction to not just the Iran war, but also inflation. We've talked about this at the onset of the war. Let's address this now that a memorandum has been reached between the Iranians and the Americans. So we have more data now to assess this. Gold has historically been seen as an inflation hedge and a hedge against geopolitical uncertainty. It's done neither of those things this year. In fact, it's gone down as inflation print's gone up, and it's gone down as geopolitical tensions ratcheted up in the Middle East. Why is that?
Well,
and has that changed the narrative for you?
Well, the only way I'm going to answer it is truthfully how I feel. It's a quagmire.
Sure.
The most dangerous market assumption is believing assets must behave the way textbooks say they should. According to Gary Wagner, the real signal isn't gold falling during uncertainty. It's that traditional relationships stopped working. When historical reactions disappear, capital often begins pricing something larger beneath the surface. Investors protecting wealth should pay attention because regime changes rarely announce themselves in advance. Next, Gary Wagner reveals why gold's failure to act like a classic hedge may expose a deeper shift in institutional positioning.
There's not a clear-cut reason for why we've seen that paradigm shift. I remember when it first occurred and I saw gold going down and military action going on in Iran, I said, there's something unusual happening here. Is this truly a paradigm shift? And to me, if gold is going to remain the absolute hedge against inflation, hedge against uncertainty, or a major hedge, let's say, not the ultimate, then that paradigm really shouldn't shift. Now, it might be that the conflict in Iran and the United States wasn't perceived in the same way we perceive the war between Russia and Ukraine. That's a multi-year thing. Nobody sees any kind of real solution when there's both sides want certain things that are what do you want to call it, that have to be accomplished before they'll accept it. In other words, these are key pegs. If Russia's going to stop the war, they want this land here. The Ukraine says, if we're going to stop the war, you need to stop bombing, we'll stop bombing, but we're not giving up any of our territory. So those are issues in which it seems as though each side is unmovable, whether you want to take sides or not, whether Russia has a right to take this land, whether or not Ukraine has a right to keep part of their sovereign territory, which is kind of where I think the logic stands. You have an unbendable set of negotiations in which neither side will give up certain key parameters to achieve peace. So when you get something like that, you have a sustained military conflict that goes for years and years.
When markets ignore geopolitical fear, investors should ask what stronger force is absorbing the shock. What Gary Wagner is highlighting is that duration matters more than headlines. Short conflicts create reactions. Unresolved conflicts reshape capital flows, commodity pricing, and reserve strategies over time. That distinction matters because markets increasingly reward persistence over drama. Wealth preservation means understanding which events become structural instead of emotional. Next, Gary Wagner exposes why markets may already be pricing a different definition of safe haven entirely.
And that's what we've seen between Russia and Ukraine. It's different than when Trump went in and had military action against a country in the Middle East. On the surface, he said it was because they don't want them to have nuclear weapons. None of us know what this agreement says, how deeply it mentions, and whether or not Iran, somewhere in that agreement, has agreed to stop enriching uranium. If it's in there, wow, that would be great. If it's not, then why did Trump go in stating this is his end game and did not achieve it with the agreement that was reached? We don't know what that agreement says. So that's what I believe we have to get more information on.
Public announcements move sentiment, but missing details move capital. Gary Wagner's argument suggests the unanswered questions around outcomes matter more than the headline declaring resolution. Markets frequently price expectations first and reassess later once terms become visible. Investors who react only to declarations often miss the second wave when institutions reposition quietly behind closed doors. Protecting capital means separating messaging from measurable outcomes.